While everyone was celebrating the China-US trade truce in November, when Beijing suspended export controls on rare earths, gallium, and germanium, something critical happened that no one's talking about. China kept one metal on lockdown, silver, and they chose January 1st, 2026 as the kill date. That's 21 days from now. Let me show you why this isn't just another export restriction. It's a calculated stranglehold that will corner the US market starting New Year's Day. Think about what happened in Busan last month. Trump met with Xi Jinping. Headlines celebrated China backing down on critical minerals. Market analysts declared the trade war was cooling off. Reuters reported that Beijing suspended export controls on rare earth elements, gallium, germanium, even antimony. Wall Street cheered. But here's what they missed. China gave concessions on minerals they could afford to lose while tightening the grip on the one metal that matters most for our energy transition. Current silver price sits at $62 per ounce. That's up 115% since January 2025. The all-time high of $61.94 just got shattered. But this isn't a normal rally driven by speculation or investment demand. This is pre-positioning before a supply earthquake that most investors don't even see coming. Let me take you back to October 2024. China exported 660 tons of silver that month, an all-time record. Where did it go? London Metal Exchange vaults, New York COMEX warehouses, Swiss refineries processing metal for Western buyers. On the surface, this looked like China supplying robust Western demand, right? Business as usual. In reality, it was strategic front-loading by exporters who knew the window was closing. Chinese silver exporters understood something the Western financial media completely missed. They shipped every ounce they could before January 1st when the new state trading rules take effect. Think of it like the last commercial flights out of an airport before a government closes the border. The October surge wasn't supply meeting demand. It was an evacuation of inventory while export freedom still existed. Here's the mechanism most analysts don't understand because they're focused on price charts instead of policy documents. China's Ministry of Commerce didn't ban silver exports outright. They did something far smarter. They created a licensing monopoly that transfers control from the open market to Beijing. Starting January 1st, only companies that produce 80-plus tons annually can even apply for state-approved export licenses. How many companies in China qualify for that threshold? Fewer than 20 enterprises across the entire country. And every single one of them has state connections. Zijin Mining, Henan Yuguang, major producers aligned with Beijing's strategic objectives. No private exporters, no small miners operating independently, no spot market access for Western buyers who just want to purchase silver at prevailing prices. If you're a U.S. solar panel manufacturer who needs 1,000 ounces of silver next quarter, here's your new reality. You don't negotiate with the market anymore based on supply and demand. You negotiate with Beijing. You deal with state-approved exporters who answer to MOFCOM, China's Ministry of Commerce, not to you. Why did China pick January 1st as the implementation date? 3 calculated reasons that reveal this isn't about domestic policy. It's about strategic timing against Western vulnerabilities. First, it's immediately after the November trade negotiations where China made those headline-grabbing concessions on rare earths. While Trump was declaring victory and the financial press was writing stories about trade war de-escalation, Beijing quietly kept silver restrictions in place. The misdirection was brilliant. Give them what they expect so they don't notice what you're keeping. Second, January 1st is exactly when U.S. manufacturers finalize their Q1 supply contracts. American solar companies, electronics manufacturers, medical device makers, they all lock in orders for January through March deliveries in mid-December. But this year, no supply certainty exists. The approved exporters list won't even be finalized and published until late December, leaving American buyers scrambling to secure alternative sources with zero advance notice. Third, this date coincides perfectly with Shanghai inventory hitting decade lows. Only 780 tons remain on the Shanghai Futures Exchange right now. Compare that to over 2,400 tons sitting in those same warehouses back in 2019. China is systematically securing domestic supply before the export window closes, prioritizing their solar panel manufacturers and electronics producers over ours. And here's the kicker that proves this was coordinated at the highest levels of our government. On November 7th, 2025, just 1 week after China announced these silver restrictions, the U.S. Geological Survey added silver to its official critical minerals list for the first time. This wasn't a coincidence. The USGS saw what was coming. Silver joined copper, lithium, and rare earth elements as materials essential to our economic and national security, with supply chains vulnerable to disruption. Read that language carefully. Vulnerable to disruption. Translation: the U.S. government just officially admitted we have a silver dependency problem that threatens our industrial base. And China knows it. They've known it for months. That's why they picked this specific metal to maintain export control over, while appearing to compromise on everything else. The setup is complete. January 1st isn't just another policy implementation date on some bureaucrat's calendar. It's the day U.S. buyers lose direct market access to the world's largest silver exporter. And China picked that exact date because they knew the West wouldn't fully react until the supply lines were already cut, and our manufacturers were facing shortages they can't solve. Let's look at the numbers that prove this supply stranglehold is happening right now. Not in some theoretical future scenario, but in real-time data you can verify yourself today. Shanghai Futures Exchange, China's primary silver trading venue, currently holds 780 tons of silver in registered inventory. That's the lowest level in a decade. Back in 2019, before China's solar manufacturing boom accelerated, Shanghai warehouses held over 2,400 tons. That's a 67% drawdown in just 6 years. Where did all that metal go? China's domestic industrial consumption hit 5,200 tons annually, according to the Silver Institute's latest World Silver Survey. Solar panel manufacturing alone consumes 3,500 tons of that total. Add in electronics production, battery manufacturing for electric vehicles, medical equipment, water purification systems, all industries where China dominates global production and all requiring silver for critical components. They can't afford to export what their own factories desperately need to maintain production schedules. This isn't speculation based on analyst estimates. This is straightforward math. If China's internal industrial demand sits at 5,200 tons and their domestic mine production generates approximately 3,600 tons, they're running a 1,600-ton annual deficit just to supply their own manufacturers. How have they been filling that gap? Through imports from other countries and aggressive recycling programs. But starting January 1st, when the export valve gets turned down, that math becomes someone else's problem, specifically our problem. Now, let's talk about the actual policy document that changes everything. MOFCOM. Announcement. Number 68 of 2025, officially issued October 30th. I've read through the requirements, and here's what matters for understanding why this creates a monopoly rather than just regulation. Requirement 1. Companies must demonstrate average annual production of 80-plus tons, or 40-plus tons if they're located in Western China, where Beijing wants to incentivize mining development. That immediately disqualifies smaller miners and independent trading companies. Only major state enterprises like Zijin Mining, Henan Yuguang, and maybe a dozen others meet this production threshold. The open market of hundreds of smaller exporters, gone. Requirement 2. Applicants need 200 million RMB in credit lines. That's 28 million US dollars in available financing. This isn't about ensuring financial health or preventing fraud. This is about making certain only well-capitalized, state-aligned companies control export channels. Small private operators with perfect track records but limited credit access, automatically excluded. Requirement 3. Full ISO 9000 and ISO 14000 certifications, plus complete social insurance compliance for all employees. Again, these are barriers designed to eliminate private operators who might not have international quality certifications, even if they've been reliably exporting silver for decades. The bureaucratic requirements aren't about quality control, they're about consolidating power. Requirement 4. Documented export performance from 2022 through 2024. If you weren't already exporting silver at significant scale during those years, you can't start now. No new entrants, no competition, no market disruption of the approved oligopoly. The application deadline was November 12, 2025, provincial. Commerce bureaus had to consolidate all applications and submit them to MOFCOM by that date. After a 7-day public notice period for objections, the final approved exporters list gets published and locked in for the entire 2026 to 2027 period. That list determines who can legally export silver from China for the next 2 years. And here's the strategic brilliance that most Western analysts completely miss. This isn't a quota system. It's not a tariff adding costs to exports. It's a licensing monopoly that Beijing can tighten or loosen whenever they want by simply adjusting who stays on the approved list, or how much each approved exporter can ship. The control mechanism is invisible to outsiders, but absolute in its power. Now, let's look at what's happening in the actual physical silver market, because the paper price on futures exchanges doesn't tell you the full story of supply stress. In March 2025, silver lease rates in London spiked to over 15% annualized. For context, lease rates normally hover near zero, 0.5% or less in stable market conditions. Why the sudden explosion? Because physical silver was being pulled out of circulation by buyers who wanted to vault metal rather than keep it liquid in the lending market, where it could be borrowed and sold short by traders. By September, during peak supply stress, lease rates hit 30 times normal levels. Traders operating on the ground in Singapore reported that major banks couldn't source leasable silver for commercial transactions. The same desperate hunt for available metal played out in Zurich, where refineries were rationing allocations to longtime customers. This wasn't a temporary squeeze that resolved after a few days. It lasted months. Industry insiders now estimate that freely circulating silver inventory, meaning metal that's available for immediate commercial transactions and not locked in ETF vaults or long-term storage, sits below 4,000 tons globally. For perspective, in normal market conditions with healthy liquidity, you'd typically see 15,000 plus tons of readily available inventory that can move between buyers without restrictions. What's causing this systematic withdrawal of physical metal from circulation? Smart money positioning before January 1st eliminates their supply options. If you're an industrial buyer who needs guaranteed silver deliveries throughout 2026 to keep your production lines running, you're not waiting around to negotiate with Chinese state exporters under the new licensing system. You're buying now at $62 per ounce and vaulting it in London or New York, where you control access. If you think I'm exaggerating the potential impact of China's export restrictions, look at what happened with rare earth elements in 2010 when Beijing implemented similar controls. China controlled 97% of global rare earth supply at that time. They introduced export restrictions, not outright bans, just quotas and licensing requirements similar to what we are seeing now with silver. Prices for neodymium, critical for electric motors and wind turbines, skyrocketed 500% plus within 18 months. Dysprosium used in high-performance magnets went up 2,000%. Western manufacturers who'd been relying on cheap Chinese supply suddenly faced existential procurement crises. The U.S. scrambled to restart the Mountain Pass mine in California, which had been shuttered for years, because it couldn't compete with Chinese pricing. It took 5 years for global supply chains to adjust and find alternative sources. Silver is different from rare earths in one absolutely critical way. There's no quick restart option for shuttered mines. The largest silver-producing countries are Mexico, Peru, China, Chile, and Poland. None of them can ramp production fast enough to replace Chinese exports if Beijing turns down the valve. The average lead time for bringing a new silver mine from discovery to commercial production? 7 to 10 years minimum when you factor in exploration, permitting, financing, construction, and ramp-up. And here's the kicker that makes silver's supply situation even more precarious than rare earths. Unlike rare earth elements, which can be recycled from old electronics and magnets, silver gets consumed in irreversible industrial processes. When silver goes into a solar panel as the conductive paste on photovoltaic cells, it's not economically recoverable. When it's used in medical bandages for antimicrobial properties, it's gone forever. There's no circular economy for most industrial silver applications. So, when China restricts exports starting January 1st and U.S. buyers realize they can't source spot silver on the open market anymore, because that market no longer exists, replaced by state-approved allocation channels, there's no backup plan. There's no strategic petroleum reserve equivalent for silver. There's no emergency stockpile. There's just a bidding war for whatever remains available from non-Chinese sources. And those sources produce barely enough to cover existing commitments, let alone absorb displaced Chinese supply. Let's do the math on what January 1st actually means for global silver supply and where prices have to go to rebalance this market. Global silver demand in 2025 sits at approximately 1.2 billion ounces, according to the Silver Institute. That includes industrial use at 750 million ounces, investment demand around 200 million ounces, jewelry at 180 million ounces, and silverware consuming 70 million ounces. That's total demand across all categories. Global mine supply produces 985 million ounces annually. Add in recycling, which contributes about 175 million ounces from old electronics, jewelry, and industrial scrap, and you get total supply of 1.16 billion ounces. Notice the problem? That's a 40 million ounce deficit before China restricts exports. We're already running short. Now, here's where it gets critical for understanding the price implications. China exports about 4,200 tons annually. Convert that to ounces. That's 135 million ounces. They're the world's fourth largest silver producer. But because their massive domestic industrial consumption eats up most of what they mine, they're a net exporter by only a relatively slim margin compared to their production. If the January 1st licensing system reduces Chinese exports by just 30%, not even a full shutdown, just reduced approval volume as state exporters prioritize domestic buyers, that removes 40 million ounces from global supply. Combined with the existing deficit, you're looking at a total shortage of 80 million ounces. That's 7% of global demand, with no immediate supply source to fill the gap. So, what price does silver need to hit to balance this market? There are only 3 ways a deficit of this magnitude resolves itself, and none of them happen quickly. First, demand destruction. Higher prices make marginal applications uneconomical, forcing industrial users to reduce consumption. At $70 to $75 per ounce, some manufacturers start seriously looking for substitutes or engineering ways to reduce silver content in their products. Solar panels might use slightly less efficient conductive pastes. Electronics makers might accept lower performance specifications. But this process takes months of R&D and production line adjustments. Second, increased recycling becomes economically viable. At higher prices, recovering silver from old electronics, jewelry, photographic film, and industrial waste starts making financial sense. Sources that aren't worth processing at $30 per ounce become profitable at $70 per ounce. But scaling up recycling infrastructure takes 6 to 12 months minimum. You need collection networks, processing facilities, refining capacity. Third, mining production acceleration. Existing mines increase output, and mothballed operations get restarted. But here's the fundamental problem with silver. Primary silver mines, where silver is the main product, are extremely rare. Most silver comes as a byproduct from copper, zinc, and lead mining operations. You can't just produce more silver without increasing base metal mining, which requires years of capital investment and expansion. Current silver price sits at $62 per ounce. That's already reflecting some of the January 1st risk, because sophisticated institutional buyers understand what's coming. But it's not reflecting the full supply loss yet, because most market participants don't understand the licensing mechanism or how drastically it changes procurement dynamics for Western buyers. Analyst consensus from major banks is calling for $65 to $68 per ounce by Q1 2026. That's too conservative based on the supply math. Here's why their models are wrong. The gold-silver ratio right now stands at 67.96. Gold trades at $4,215 per ounce. Silver at $62 per ounce. Historically, during supply crisis periods, this ratio compresses significantly. Silver outperforms gold because industrial users desperately bid for physical metal. In 2011, when silver hit its previous high of $49 per ounce, the ratio compressed to 31. Even a modest compression to 60 puts silver at $70 per ounce, just based on relative value to gold. But the fundamentals supporting silver are dramatically stronger now than they were in 2011. The solar industry alone uses 50% more silver today than total global industrial demand consumed back in 2011. Electric vehicle production is 10 times higher, and every EV contains silver in electrical contacts and circuit boards. The deficit isn't driven by speculative investment flows that can reverse. It's structural industrial demand that must be filled, or production stops. Target price, $70 to $75 per ounce by Q2 2026. And that's the equilibrium price where supply and demand rebalance through the three mechanisms I described. That's not the spike price during acute shortage periods when desperate buyers compete for limited spot availability. Here's the specific timeline you need to watch because this unfolds with mathematical precision. December 31st, 2025. Current silver export rules expire at midnight Beijing time. Chinese companies can still ship under the old open market system until that deadline. January 1st, 2026. New state trading licensing requirement takes effect. Only approved exporters on MOFCOM's published list can legally ship silver outside China. Late December 2025. MOFCOM publishes the final approved exporters list. This is the list of approximately 20 companies that control all Chinese silver exports for the next 2 years. Western buyers will finally see who they're forced to negotiate with. January 15, 2026. U.S. manufacturers finalize Q1 procurement contracts. Solar panel companies, electronics manufacturers, medical device makers, they all need to lock in supply agreements for February through April production. This is standard industrial procurement timing, but here's the critical problem that creates immediate price pressure. The approved Chinese exporters won't have their licensing logistics, documentation systems, and shipping procedures fully operational immediately. First shipments under the new state trading system will likely be delayed 2 to 3 weeks while bureaucratic processes get established. That means American buyers who normally would receive January deliveries are looking at late January or early February arrivals at best. That creates a 30 to 45-day supply gap where Western industrial users either draw down whatever inventory they have on hand or compete for non-Chinese supply sources at premium prices. And when U.S. buyers collectively realize they can't source spot silver from China anymore, because the open market has been replaced by state-approved allocation channels that prioritize Chinese domestic needs, they'll start aggressively bidding up Mexican, Peruvian, and Chilean supply. Expect significant regional pricing dislocations. Silver in New York could easily trade $3 to $5 per ounce higher than London just due to logistical constraints and supply availability. Refineries in North America will command premium prices because they eliminate the shipping time from overseas sources. Let me be absolutely clear about what this means for anyone paying attention. If you're holding silver right now at $62 per ounce, you're positioned before the market fully prices in the supply loss that mathematically must occur when China's export restrictions take effect. The January 1st implementation is real. It's published policy, not speculation. The licensing monopoly is real. The requirements are documented in official MOFCOM announcements. The supply-demand math is real. You can verify every number I've given you through industry sources. Could prices pull back in late December? Possibly. Tax loss selling from investors closing positions before year-end, profit-taking from traders who've ridden the rally, normal year-end position squaring by funds. There could be short-term volatility that creates buying opportunities. But the structural setup remains unchanged. China is restricting supply starting January 1st. Industrial demand continues growing, and there's no alternative source that can replace lost Chinese exports. The smart money, the ETF buyers who've pulled 200+ million ounces out of circulation this year, the banks paying 30 times normal lease rates to secure physical metal, the industrial users stockpiling inventory despite the high prices, they're not waiting to see what happens January 1st. They're positioned now because they understand the math. And here's the final piece that makes this different from every other commodity supply disruption. Unlike rare earths, where the U.S. could eventually restart domestic mines like Mountain Pass, silver doesn't have that option at scale. The United States produces about 30 million ounces annually from primary and byproduct mining. That's 2.5% of global supply. Even if we doubled domestic production overnight, which is physically impossible, it wouldn't come close to offsetting the loss of access to Chinese exports. January 1st, 2026. That's the date China picked. Not because it's simply the start of a new calendar year, but because it's the precise moment they formalize control over a metal the modern world cannot function without. The supply restriction begins in 21 days. The question isn't whether prices rise. The math guarantees it. The question is, are you positioned for what comes next? If you found this breakdown valuable, hit the like button and subscribe, because this is the kind of dot-connecting analysis the mainstream financial media won't show you. Drop a comment. What's your silver target for Q1 2026? And if you want to dive deeper into the specific MOFCOM licensing requirements, I've linked the original policy documents in the description below. Thanks for watching. I'll see you in the next one.